Right then, good afternoon, folks, and just an update from us at the end of another week of trading. We'll start with the calendar. We'll flick across some charts on a pretty negative week across financial markets. We'll start obviously on Monday, where we didn't have much going on for us on Monday, and certainly in terms of the calendar. A bit of negativity to start the week. We had the Chinese cut their interest rates by not as much as markets were anticipating. Markets were hoping for a bit more of a cut than we did get from the PBOC in order to lend support to their economy, which has not fared as some market participants may have hoped since their exit from their COVID lockdown measures. And that kind of disappointed markets at the start of the week, and we have not really looked back. Obviously, we had a range of hawkish central banks last week, which we covered last week, into this week, which markets didn't really pay attention to last week. They were just like, I don't really care, we're just going to pump higher anyway. Markets have woken up a little bit to the situation over the course of this week. Now, and it's a Tuesday, where with the RBA, the minutes from the RBA, which did suggest that they were going on, that they considered not even hiking interest rates at their last meeting. They decided to do it just to kind of get ahead of the eight ball, but in terms of the committee members, they decided that maybe hiking interest rates wasn't the best thing, and the fact that we've got two surprise interest rate hikes now, they did allude to the fact that it may be appropriate to continue with ongoing increases. Markets are now sort of expecting that is not going to be the case. They're going to be data dependent going forward. We're going to have to keep an eye on the economic data in relation to Australia, like many other, or all of the other central banks around the world at the moment. But that, coupled with the Chinese disappointing plus stock index lower, has made a bad week for the Australian dollar, which we'll have a look at across now in a minute. Into inflation, CPI from the UK continues to be an issue. Right, you can see here, previous 8.7%, consensus 8.4%. Actually, we came in 8.7%. Now, the core CPI print, which I think is more important when it comes to the UK, if I just flick on this back to the medium impact, for some reason it's medium impact, and this we can see the core CPI print, previous 6.8%, consensus 6.8. We actually ticked up to 7.1, and that continues on this uptrend, as we can see here, from 5.8 to 6.2 to 6.8 up to 7.1. So inflation growing, continuing to rise in the UK, which means the central bank, once we came around to it on yesterday, we're in a very difficult position, and what they have done is they have gone and they have hiked interest rates by 50 basis points. Now, we've had a bit of time to digest that and come to some sort of conclusion about that, but market consensus was for 25 basis points. What we got was 50. Now, 7 out of the 9 committee members did vote for this 50 basis point for this 50 basis point hike, apart from Tenreiro and Dingra, which did suggest no hike, which they do every meeting. But seven out of the 9 wanted a 50 basis point hike. Now, that is the Bank of England showing some initiative, something that they have not done in the past. They've gradually increased, but now they've taken some initiative. They're trying to do what they should have done already, by stamping their foot down and saying, no, we have to get control of this. We are going to get control of this. Now, inflation continues to be a problem, but if they really start to hammer these interest rates, which markets are expecting potentially a terminal rate of 6%, come the end of their hiking cycle, that is likely to hike the economy into a recession. But maybe that's the only option left, is to just suck it up, hike the economy into recession, and that decrease in activity will cause a cool down on prices, and it will get inflation under control. And that is seemingly what they may have to do, or in my opinion, probably what they should do. I think if mortgage rates continue to rise, people's cost of living on a day-to-day basis continues to rise, a recession for 6 months probably causes less problems, you would imagine, than the cost of living crisis continuing for too much longer. But instead of cost of living crisis, retail sales this morning did come in higher than anticipated. So people still spending money, consumers still spending money in the midst of this cost of living crisis. So yeah, maybe people don't feel the brunt of it too much, or just continuing to spend money they don't have. I don't know. But I was reading an article about at the Beyonce concert. Apparently that was some sort of an increase to inflation. Retail sales, people spending a lot of money heading towards that Beyonce concert. So whether that plays an impact in next month's figures or this month's figures that we will get next month, obviously remains to be seen. But the Bank of England is certainly in a difficult position, as well as the central banks globally, in order to tackle this inflation scenario. Jerome Powell testimony is semi-annual, or biannual should I say, update on monetary policy, reaffirming his stance of last week that ongoing rate increases will be appropriate. He said it will be a good guess to suggest that interest rates will increase gradually, reaffirmed the fact that they're expecting 50 basis points hike by year end, and did not change his tune from last week, which markets didn't really care about last week, but he has stuck to that this week, and markets haven't seemed to be taken too positive, or haven't seemed to take too positively to it, should I say, over the course of this week. We get back on the medium impact data release, and we'll come around to today then. Pretty busy day, but we got core CPI, we got CPI in Japan remaining to be an issue, right? I'm gonna have to get the low impact numbers up to see the actual number that I think makes for the most, or that we should read into the most when it comes to this. We'll just have a look at this inflation rate excluding food and energy, right? 4.3% year over year, continues on the previous of 4.1. You can see the back, this continues on its uptrend from 1 to 1.2 to 1.6, 1.8. Also, I'm not going to call out every single number, but it's a steady increase every single month over the past year. Now, if that continues to rise, the central bank are going to have to think about that and potentially alter monetary policy. Now, if they were to come out and start talking about interest rates being hiked, that is surely the trade of the year in terms of the Japanese yen. You'd have to imagine the Japanese yen goes through the roof off the back of that. And that's probably a risk that financial markets maybe aren't taking into consideration. If the Bank of Japan do start to hike interest rates, do remove yield curve control, that's, I say, easiest trade you'll ever take in your life. Probably in terms of a directional bias on the Japanese yen actually getting into it, obviously is a completely different question. But hiking interest rates in Japan, they've had near zero interest rates since the mid-90s. Surely that is a sure as I kind of bet the house on a trade that goes higher. Whether you can get into it without your stop loss being hit in the midst of heightened volatility is a completely different question. But maybe some long calls on the Japanese yen might be a decent bet into year end this year. But obviously we'll have to see how that plays out as we go on forward. On to some PMIs today out of the Eurozone, some negative PMIs across the board. You can see the manufacturing PMI out of Germany, 41 versus a consensus of 43.5. Bad. You can look at the Eurozone, 43 versus a consensus of 44.8. Bad. The services ones are kind of holding firm, but manufacturing PMIs negative. Manufacturing PMIs out of the UK negative as well. So negative manufacturing, pointing towards difficulties for the manufacturing sector going forward, which is obviously a large component of that Eurozone economy. And what that has done is that has caused some substantial downside across the board in the euro today, which has helped the dollar to continue higher. We can see charts over the course of this week. You can see Aussie dollars lower, what we mentioned earlier. Kiwi dollars lower as well. Euro dollar lower. Sterling remaining surprisingly resilient. Maybe markets are taking some comfort in the fact of sterling, that the central bank is trying to get ahead of the eight ball. It is trying to get to grips on inflation. Maybe it brings it back a little bit more confidence in the Bank of England, which maybe is a reason why this is held firm over the course. I say held firm, I mean it is still grinded lower, but somewhat held firm, as you can see, over the course of this week. So a little bit tricky trading in terms of cable this week. The clear directional bias, certainly over today and yesterday, is on that euro dollar. Dollar yen continues to push higher. Dollar Swiss continues to push higher. This dollar CAD one though is interesting. Dollar CAD has trended lower when everything else has trended lower against the dollar. The Canadian dollar has traded higher against the dollar over the course of this week. Maybe markets backing potential for further interest rate hikes in Canada. You've got strong growth, strong inflation in Canada, strong retail sales and housing market figures the other day out of Canada, and that kind of fuels the fire of potential interest rate hikes to come from the Bank of Canada after they went on pause. So that's kind of where we are looking across the board in currencies. You can see stock indexes, S&P lower, Dow Jones lower, the Nasdaq lower. Did have a bit of a pop higher yesterday, but still lower over the course of a week. Got the Russell lower. Now, we were speaking about this head and shoulders on the Russell last week. Good barometer for the health of the economy. Obviously, the global economy is struggling at the moment. This head and shoulders, the neckline broke through, and we do continue on lower. The DAX lower, FTSE lower, Nikkei lower, VIX also lower, but market's a little bit discombobulated at the moment. But you kind of have gaps higher and then moves back lower, which a little bit tricky trading in terms of the VIX this week. But I'm more concerned about what's going on across the board in stock indexes, and you can see clear negativity wherever you look. Commodities, you got gold lower, silver lower, oil lower, copper lower. Cryptocurrencies are somewhat stabilized after a solid run higher, but not too worried about them at the moment. But you got commodities across the board lower. So again, equities lower, commodities lower, US dollar higher. It's just negative trading across the board. But you've got this, then you've got got bond yields pretty much chopping sideways over the course of this week's trading. But you've got yield curve inversions. You've got 2-year yield higher than the 10-year yield on the UK. You've got the 2-year yield higher than the 10-year yield in Germany. You've got the 2-year yield higher than the 10-year yield in the US, and you have got inverted yield curves across each of these economies, which does signal a potential recession coming forward. The German yield curve hit its highest inversion, or highest inversion in since 1992. Off the back of that data this morning, the UK has hit its largest inversion since 2010 over the course of yesterday. So definitely bond markets signaling negativity surrounding the global economy going forward. That is a situation where these stock indexes should in theory continue lower, but backing stock indexes lower doesn't work a lot of the time. You just deludedly back stock indexes higher, most of the time you'd be alright. But certainly we are in an environment where it is not positive for stocks. You'd have to imagine stocks struggle to gain any meaningful upside over the foreseeable future. But again, if you just woke up every day for the next 30 years, closed your eyes and went along stocks, you'd probably do all right. But as of now, lower stocks seems the way to play it. Certainly souring risk sentiment over the course of this week, and some clear negativity across financial markets this week.